Welcome to the Finance Hub, where we uncover the secrets of wealth and success. Today, we're diving into a powerful strategy that the rich use to multiply their wealth, making money with debt. That's right, not all debt is bad. Let's explore 15 ways the wealthy leverage debt to build their fortunes. Number 1. Real estate investment. This is one of the most common and powerful ways the wealthy use debt to their advantage. Let's dive deeper into how this works. Wealthy individuals often take out mortgages to buy properties. A mortgage is a type of loan specifically for purchasing real estate. When they secure a mortgage, they typically make a down payment, which is a small percentage of the property's total value, and the bank or lender provides the remaining amount as a loan. The property itself serves as collateral for the loan. Once they own the property, they rent it out to tenants. These tenants pay monthly rent, which provides a steady stream of income. In many cases, the amount collected in rent is enough to cover the mortgage payments. This means that the property is essentially paying for itself, allowing the investor to build equity without using their own money for the mortgage payments. Additionally, over time, properties generally appreciate in value. Real estate markets, especially in desirable locations, tend to increase over the long term. This appreciation means that the value of the property rises, making it an even more valuable asset. So, not only is the investor benefiting from the rental income, but they are also gaining from the increasing value of the property. When the mortgage is finally paid off, the owner is left with a highly valuable asset. At this point, they have several options. They can continue to rent it out and enjoy higher profits since there is no longer a mortgage to pay, or they can sell the property for a significant profit due to its appreciated value. Moreover, real estate investment comes with various tax benefits. For instance, mortgage interest and property taxes can often be deducted from taxable income, which reduces the overall tax burden. In some cases, depreciation of the property can also be used as a tax deduction. This combination of rental income, property appreciation, and tax benefits makes real estate investment a powerful tool for building wealth through debt. That's why many of the world's wealthiest people have substantial portions of their portfolios invested in real estate. It's a tried and true method for making money with debt, leveraging borrowed funds to create significant financial gains. Number 2. Business loans. This is a key strategy that many successful entrepreneurs use to grow their businesses and achieve greater financial success. Entrepreneurs often take out business loans to either start a new business or expand an existing one. These loans can come from various sources, such as banks, credit unions, or specialized financial institutions that cater to business needs. The primary purpose of these loans is to provide the necessary capital that the entrepreneur might not have readily available. When starting a business, initial capital is crucial for various needs, including purchasing equipment, leasing premises, hiring employees, and buying inventory. By securing a business loan, entrepreneurs can cover these startup costs without depleting their personal savings. This access to capital allows them to launch their business and begin generating revenue much sooner than if they had to save up the entire amount themselves. For existing businesses, loans are often used to fund expansion projects. This might include opening new locations, launching new product lines, or investing in significant marketing campaigns. By borrowing money to finance these growth initiatives, businesses can scale up their operations more quickly and efficiently. This rapid growth can lead to higher revenues and increased market share. The key advantage of using business loans lies in the concept of leverage. By leveraging borrowed funds, businesses can achieve higher returns on their investments. For instance, if a business takes out a loan at an interest rate of 5%, but the investment generates a return of 15%, the net gain is substantial. The cost of borrowing is outweighed by the profits generated from the investment, leading to overall financial growth. Moreover, interest payments on business loans are often tax deductible, which can further enhance the financial benefits. This tax advantage reduces the effective cost of borrowing, making loans an even more attractive option for business financing. Another important aspect is that access to sufficient capital can help businesses take advantage of time-sensitive opportunities. Whether it's purchasing inventory at a discount, acquiring a competitor, or capitalizing on a market trend, having the financial flexibility to act quickly can provide a significant competitive edge. In summary, business loans are a vital tool for entrepreneurs seeking to start or expand their ventures. By borrowing money to invest in their business, they can achieve higher returns than the interest they pay on the loan. This strategy not only fuels business growth, but also maximizes financial gains, contributing to the overall success and expansion of the business. Number 3. Leveraged investments. This is a sophisticated strategy employed by wealthy investors to enhance their returns by using borrowed money. In essence, leveraging involves borrowing funds to invest in various financial assets such as stocks, bonds, or other investment vehicles. The idea behind this approach is to use debt as a tool to increase the potential return on investment. Here's how it works. When investors use their own money to purchase assets, their returns are limited to the performance of those assets. However, by borrowing additional funds, they can invest a larger amount than they would be able to with just their own capital. For example, if an investor has $100,000 and borrows another $100,000, they can now invest $200,000 in assets. This doubles their potential for profit. If the investments perform well and generate returns, the gains are magnified because they are based on the larger invested amount. Let's say the $200,000 investment grows by 10%. The total value now is $220,000. After repaying the borrowed $100,000 plus any interest, the investor keeps the remaining profit. If the interest on the loan is 5%, they owe $105,000, leaving them with $115,000. This results in a net gain of $15,000 on their original $100,000 investment, which is a 15% return, compared to the 10% they would have earned without leveraging. However, it's important to note that leveraging also amplifies losses. If the investments perform poorly, the losses are also magnified because the investor must still repay the borrowed amount plus interest. For example, if the $200,000 investment decreases by 10%, its value drops to $180,000. The investor still owes $105,000, leaving them with $75,000, a 25% loss on their original investment. This risk factor means that leveraging must be approached with caution and a thorough understanding of the potential market conditions. Wealthy investors often use leveraged investments because they can handle the associated risks and have access to favorable borrowing terms. They might secure loans at lower interest rates or use assets as collateral to obtain the necessary funds. This strategic use of debt enables them to take advantage of opportunities that can significantly enhance their wealth. Additionally, leveraging can be part of a diversified investment strategy. By spreading leveraged investments across various asset classes, investors can manage risk more effectively and capitalize on different market opportunities. For instance, they might leverage investments in a mix of stocks, real estate, and bonds, each offering different levels of risk and potential return. In summary, leveraged investments allow wealthy investors to use borrowed money to increase their investment in stocks, bonds, or other assets, amplifying their potential gains. While this strategy can significantly enhance returns, it also comes with increased risk, requiring careful planning and risk management. By leveraging their investments wisely, the wealthy can maximize their financial growth and build substantial wealth over time. Number 4. Tax benefits. One of the significant advantages of using debt strategically is the potential tax benefits it can offer. Certain types of debt, such as mortgage interest and business loans, can be tax deductible, which can substantially reduce the overall tax burden for individuals and businesses. When it comes to mortgage interest, the tax code allows homeowners to deduct the interest paid on their mortgage from their taxable income. This deduction applies to both primary residences and, in many cases, secondary homes. By lowering the taxable income, homeowners can reduce the amount of income tax they owe, making homeownership more affordable. For example, if a homeowner pays $10,000 in mortgage interest over a year and falls in the 25% tax bracket, they can potentially reduce their tax bill by $2,500. This deduction can make a significant difference, especially for those with substantial mortgage interest payments. Similarly, business loans come with their own set of tax advantages. The interest paid on business loans is typically considered a business expense and can be deducted from the business's taxable income. This deduction can apply to various types of loans, including those taken out for starting a business, expanding operations, purchasing equipment, or even covering day-to-day operational costs. By deducting interest expenses, businesses can lower their taxable income, which in turn reduces their overall tax liability. For example, if a business pays $50,000 in interest on a loan over a year and falls in a 30% tax bracket, the deduction can save them $15,000 in taxes. Another area where debt can provide tax benefits is in the realm of investment properties. The interest on loans taken out to purchase or improve rental properties is often tax deductible. Additionally, landlords can deduct other expenses related to their rental properties, such as property taxes, maintenance costs, and depreciation. These deductions can significantly reduce the net taxable income generated by the rental properties, enhancing the profitability of real estate investments. Furthermore, the use of debt in certain tax-advantaged accounts, such as margin loans for investing, can also offer benefits. Interest paid on margin loans, which are used to buy additional securities, can sometimes be deductible if the funds are used to purchase taxable investments. This can be particularly advantageous for investors who are looking to maximize their investment returns while managing their tax obligations. It's important to note that while these tax benefits can be substantial, they are subject to various rules and limitations set by the tax authorities. Tax laws can be complex, and the eligibility for deductions may depend on factors such as the type of debt, the purpose of the loan, and the taxpayer's overall financial situation. Therefore, it is always advisable to consult with a tax professional or financial advisor to fully understand and take advantage of these benefits. In summary, the tax benefits associated with certain types of debt, like mortgage interest and business loans, can significantly reduce taxable income and lower the overall tax bill. By strategically using debt and understanding the associated tax deductions, individuals and businesses can enhance their financial efficiency and improve their bottom line. Number 5. Buyouts and acquisitions. This is a common strategy used by companies to expand their operations and increase their market share by acquiring other businesses. Let's break down how this process works and why debt is often involved. When a company decides to acquire another business, it might not have all the necessary cash on hand to complete the purchase. Instead, it can use debt to finance the acquisition. This involves taking out loans or issuing bonds to raise the required funds. The decision to use debt rather than equity can be strategic, as it allows the acquiring company to maintain control and ownership without diluting the shares of existing shareholders. Once the acquisition is complete, the acquiring company gains control of the acquired business's assets, operations, and revenue streams. This can provide several immediate benefits. First, the income generated by the acquired company can be used to service the debt taken on for the acquisition. For example, if Company M acquires Company B and Company B has a steady revenue stream, those revenues can help pay off the loan used to purchase Company B. This means that the debt is essentially being paid down using the earnings of the newly acquired business, rather than the acquiring company's original resources. Moreover, the acquisition can lead to increased profitability and market presence for the acquiring company. By integrating the acquired company's operations, the acquiring company can achieve economies of scale, reduce costs through synergies, and potentially increase its market share. These efficiencies can enhance the overall financial health of the combined entity, making the debt incurred more manageable and less risky over time. Additionally, acquisitions can provide strategic advantages, such as entering new markets, acquiring new technologies, or gaining access to a broader customer base. These strategic benefits can further drive growth and profitability, making the initial debt financing worthwhile. For instance, suppose a tech company acquires a smaller firm that has developed a cutting-edge technology. By integrating this technology, the acquiring company can enhance its product offerings and gain a competitive edge in the market. The revenues generated from this improved product lineup can then be used to pay off the acquisition debt, while also driving higher profits. It's important to note that while using debt for acquisitions can be highly beneficial, it also comes with risks. If the acquired company does not perform as expected, or if the integration process encounters difficulties, the acquiring company may struggle to generate the necessary cash flow to service the debt. Therefore, thorough due diligence, careful planning, and effective integration strategies are crucial to the success of such acquisitions. In summary, companies often use debt to acquire other businesses because it allows them to expand and enhance profitability without diluting ownership. The income generated by the acquired company can be used to pay off the acquisition debt, ultimately leaving the acquiring company with a valuable and profitable new asset. By leveraging debt strategically, companies can achieve significant growth and strengthen their market position. Number 6. Real estate development. This is a powerful strategy where developers use borrowed money to finance new construction projects. Let's explore how this process works and the benefits it can bring. Real estate developers typically borrow money from banks, financial institutions, or private lenders to fund the construction of new properties, such as residential homes, commercial buildings, or mixed-use developments. These loans are often structured as short-term construction loans, which provide the necessary capital to cover the costs of land acquisition, construction materials, labor, and other related expenses. The key to successful real estate development lies in the ability to manage these projects efficiently and complete them within budget and on schedule. Once the construction is complete, the developer can sell the finished properties to buyers or lease them to tenants. The income generated from these sales or leases is then used to pay off the borrowed funds. For example, suppose a developer borrows $10 million to build a luxury apartment complex. Upon completion, the developer sells the individual units for a total of $15 million. After repaying the $10 million loan plus interest, the developer is left with a substantial profit. Alternatively, if the developer leases the apartments, the rental income can be used to service the debt over time, with the potential for long-term profit as the property value appreciates. One significant advantage of using debt for real estate development is the ability to leverage the borrowed funds to undertake large projects that would otherwise be financially out of reach. This leverage allows developers to maximize their investment returns. If the project's return on investment exceeds the cost of the borrowed funds, the developer can achieve significant financial gains. Furthermore, the value of real estate typically appreciates over time, especially in desirable locations. This appreciation can further enhance the profitability of the project. For instance, if property values increase during the construction period, the developer can sell or lease the units at higher prices than initially projected, leading to greater profits. Another benefit of using debt in real estate development is the potential for tax advantages. Interest payments on construction loans can often be deducted from taxable income, reducing the overall tax burden. This can make the cost of borrowing more affordable and improve the financial viability of the project. However, real estate development also carries risks. Market conditions can change, affecting property values and demand. Construction delays or cost overruns can impact the project's profitability. Therefore, successful developers conduct thorough market research, carefully plan and manage their projects, and maintain contingency plans to mitigate these risks. In summary, real estate development involves borrowing money to build new projects, with the expectation that the completed properties will generate sufficient income to repay the debt and yield significant profits. By leveraging borrowed funds, developers can undertake large-scale projects, benefit from property appreciation, and potentially gain tax advantages, making real estate development a lucrative strategy for building wealth. Number 7. Private equity. This strategy involves private equity firms using borrowed funds to acquire companies, enhance their performance, and eventually sell them at a profit. Let's delve into how this process works and the potential benefits. Private equity firms typically raise capital from investors, including institutional investors and high net worth individuals. They then use this capital, combined with borrowed funds, to purchase companies. This method of financing acquisitions with a mix of equity and debt is known as a leveraged buyout, LBO. The rationale behind using borrowed funds is to leverage the investment, which means using less of the firm's capital and more debt to finance the purchase. By doing so, private equity firms can amplify their potential returns on investment. The borrowed funds are usually secured by the assets of the company being acquired. Once the acquisition is complete, the private equity firm takes an active role in managing the company. This often involves implementing significant operational improvements, cost reductions, and strategic initiatives to enhance the company's performance. The goal is to increase the company's profitability and overall value. For example, a private equity firm might acquire a manufacturing company that is underperforming. By streamlining operations, improving supply chain efficiency, and introducing new management practices, the firm can boost the company's profitability. These improvements can lead to higher earnings and a more attractive business to potential buyers. After the company has been turned around and its performance has improved, the private equity firm seeks to exit the investment. This can be done through various means, such as selling the company to another firm, taking it public through an initial public offering, IPO, or selling it back to its original owners or new investors. The profit from this transaction is derived from the difference between the purchase price and the sale price of the company minus the debt used in the acquisition. For instance, if a private equity firm buys a company for $100 million, using $20 million of its own capital and $80 million in borrowed funds, and later sells the company for $150 million, the firm would repay the $80 million loan and retain the remaining $70 million. Subtracting the initial $20 million investment, the firm would have a profit of $50 million. This approach offers several advantages. First, by using debt to finance the acquisition, private equity firms can control larger companies than they could with just their own capital. Second, the use of leverage can significantly increase returns on equity. Third, the active management and operational improvements implemented by the private equity firm can create substantial value. However, this strategy also carries risks. The use of high levels of debt can be risky if the acquired company does not perform as expected. If the company struggles to generate sufficient cash flow to service the debt, it can lead to financial distress or even bankruptcy. Therefore, private equity firms conduct thorough due diligence and carefully select companies with strong potential for improvement. In summary, private equity involves using borrowed funds to acquire companies, improve their performance, and sell them at a higher price. The profit is derived from the difference between the purchase and sale price minus the debt. This strategy allows private equity firms to leverage their investments, enhance company performance, and achieve significant financial gains. Number 8. Margin trading. This is a powerful investment strategy where investors borrow money from brokers to trade financial assets. Let's explore how this works and the potential benefits and risks involved. Margin trading involves using borrowed funds from a broker to purchase securities. This borrowed money, known as margin, allows investors to buy more assets than they could with their own capital alone. Essentially, it amplifies the investor's buying power. To begin margin trading, an investor must open a margin account with a brokerage firm. The investor is required to deposit a certain amount of their own money, known as the initial margin. This initial deposit acts as collateral for the loan from the broker. The brokerage firm then lends the investor additional funds to buy securities. For example, suppose an investor wants to buy $10,000 worth of stock but only has $5,000. By using a margin account, they can borrow the remaining $5,000 from their broker and purchase the stock. This enables the investor to control a larger position than they could with just their own money. The primary advantage of margin trading is the potential to increase profits. If the value of the securities purchased on margin rises, the investor can sell them at a higher price, repaying the borrowed funds and keeping the profits. For instance, if the $10,000 worth of stock appreciates to $12,000, the investor can sell the stock, repay the $5,000 loan, and pocket the remaining $7,000. In this case, the investor's initial $5,000 investment has grown by $2,000, resulting in a 40% return, compared to a 20% return if they had only invested their own money. However, margin trading also carries significant risks. If the value of the securities falls, the investor must still repay the borrowed funds. For instance, if the stock's value drops to $8,000, the investor still owes the broker $5,000. After selling the stock and repaying the loan, the investor is left with only $3,000, resulting in a 40% loss on their initial $5,000 investment. This demonstrates how losses can be magnified just as easily as gains. Another risk is the potential for a margin call. If the value of the securities in the margin account falls below a certain level, the broker may require the investor to deposit additional funds or sell some of the assets to bring the account back to the required margin level. This can force investors to sell at a loss, further increasing their financial risk. To manage these risks, it's crucial for investors to use margin trading judiciously. They should have a clear understanding of their risk tolerance and the market conditions. Additionally, setting stop-loss orders can help limit potential losses by automatically selling the securities if their price drops to a predetermined level. Despite the risks, margin trading can be an effective tool for experienced investors seeking to maximize their returns. By leveraging borrowed funds, they can take larger positions in the market, potentially achieving higher profits. However, it's essential to approach margin trading with caution and to have a solid risk management strategy in place. In summary, margin trading allows investors to borrow money from brokers to trade financial assets, enabling them to buy more than they could with their own funds alone. This can potentially increase their profits, but it also magnifies the risks, making it essential for investors to carefully manage their investments and understand the potential pitfalls. Number 9. Credit lines for cash flow. This strategy is vital for businesses looking to effectively manage their finances and navigate cash flow fluctuations. Let's explore how businesses utilize lines of credit to maintain financial flexibility and seize opportunities. Businesses often encounter variations in cash flow due to seasonal sales patterns, client payment delays, or unexpected expenses. To bridge these gaps and ensure uninterrupted operations, businesses establish lines of credit with financial institutions. A line of credit is a flexible loan arrangement that allows businesses to borrow funds up to a predetermined limit, similar to a credit card, but with lower interest rates and higher limits. The primary purpose of a business line of credit is to provide access to funds quickly and as needed. Unlike traditional term loans, where the entire loan amount is disbursed upfront and repaid in fixed installments, a line of credit allows businesses to borrow funds on an as-needed basis. This flexibility is crucial for managing day-to-day expenses, making payroll, purchasing inventory, or seizing unexpected growth opportunities. For example, a retail business might experience a surge in sales during the holiday season but needs additional funds to stock up on inventory. By tapping into its line of credit, the business can quickly purchase inventory to meet customer demand without disrupting cash flow. Once the seasonal sales generate revenue, the business can repay the borrowed funds, minimizing interest costs. Lines of credit also provide businesses with a financial cushion to navigate unforeseen challenges or emergencies. Whether it's repairing equipment, covering unexpected operating expenses, or managing a temporary decline in revenue, having access to a line of credit ensures that businesses can address these issues promptly without resorting to more costly forms of financing. Moreover, lines of credit can be a strategic tool for growth and expansion. Businesses can use the funds to invest in new projects, launch marketing campaigns, or expand into new markets. This ability to leverage borrowed funds for strategic initiatives can accelerate business growth and enhance competitiveness in the marketplace. Another advantage of lines of credit is their revolving nature. As businesses repay the borrowed funds, the available credit limit replenishes, providing ongoing access to capital. This revolving feature contrasts with term loans, where additional borrowing requires a new application process. It's important to note that lines of credit require responsible management to maximize their benefits. Businesses should maintain a clear repayment plan and use the funds judiciously to avoid accumulating excessive debt. Monitoring cash flow and budgeting effectively are essential practices to ensure that lines of credit contribute positively to the financial health and sustainability of the business. In summary, lines of credit are essential financial tools that businesses use to manage cash flow gaps, seize opportunities, and navigate challenges. By providing flexible access to funds, lines of credit enable businesses to maintain operations smoothly, pursue growth initiatives, and respond swiftly to changing market conditions, ultimately supporting long-term success and resilience. Number 10. Leveraged buyouts, LBOs. This investment strategy involves investors using borrowed funds to acquire companies, leveraging the assets of the target company to secure the necessary financing. Let's delve into how leveraged buyouts work and why they are a popular strategy in the world of corporate finance. Leveraged buyouts, LBOs, typically occur when a group of investors or a private equity firm seeks to acquire a company, often with the goal of taking it private or restructuring its operations to enhance profitability. The investors contribute a portion of their own capital, while the majority of the purchase price is financed through debt. The borrowed funds used in LBOs are typically secured by the assets of the target company itself. This collateralization provides lenders with a level of security, as they can seize and sell the company's assets in the event of default. The ability to use the target company's assets as collateral reduces the amount of upfront capital required from the investors, allowing them to control a larger company than they could with their own funds alone. For example, suppose a private equity firm wishes to acquire a manufacturing company valued at $100 million. Instead of using $100 million of their own capital, the firm might secure $80 million in debt financing, with the manufacturing company's machinery, equipment, and other assets serving as collateral. The private equity firm would then contribute $20 million of its own capital to complete the purchase. Once the acquisition is complete, the private equity firm takes an active role in managing the acquired company. This often involves implementing operational improvements, cost-cutting measures, and strategic initiatives aimed at enhancing efficiency and profitability. By doing so, the firm aims to increase the company's cash flow and overall value over time. The ultimate goal of an LBO is to generate a substantial return on investment for the investors. This return comes from several sources. First, the operational improvements and increased profitability of the acquired company. Second, the appreciation in the value of the company over the holding period. And third, any dividends or distributions paid out during the ownership period. Once the private equity firm has successfully improved the company's performance and increased its value, it may seek to exit the investment. This exit strategy can involve selling the company to another buyer, taking it public through an initial public offering, IPO, or selling it back to its original owners or management team. The profit from the LBO transaction is calculated based on the difference between the purchase price and the eventual sale price of the company, minus the debt and any expenses incurred during the holding period. If executed successfully, LBOs can generate substantial returns for investors, making them a lucrative strategy in the world of corporate finance. However, leveraged buyouts also come with significant risks. The high level of debt used to finance the acquisition can strain the financial resources of the acquired company, especially if the business environment deteriorates or if the operational improvements do not yield the expected results. Additionally, changes in interest rates or economic conditions can impact the cost and availability of debt financing, affecting the feasibility of the LBO transaction. In summary, leveraged buyouts, LBOs, involve investors using borrowed funds to acquire companies, leveraging the assets of the target company to secure financing. This strategy allows investors to control larger companies with less upfront capital and aims to generate significant returns through operational improvements and increased company value. While LBOs can be highly profitable when successful, they also involve substantial risks that require careful assessment and management. Number 11. Student loans for high ROI education. This strategy involves wealthy individuals using student loans to finance education in fields known for high earning potential. Let's explore how this approach works and why it can be a financially savvy decision for those pursuing lucrative careers. In certain professions, such as medicine, law, engineering, and finance, advanced education is often a prerequisite for entry and career advancement. These fields typically offer higher salaries and strong job prospects, making them attractive for individuals seeking a solid return on investment, ROI, for their educational expenses. Wealthy individuals may choose to take out student loans to cover the cost of tuition, fees, and living expenses associated with obtaining an advanced degree or professional certification. The decision to use loans rather than pay tuition outright allows them to preserve their liquid assets and potentially benefit from investment opportunities with higher returns than the cost of borrowing. For example, suppose a wealthy individual pursues a medical degree with the intention of becoming a specialized surgeon. The cost of medical school tuition and related expenses can amount to hundreds of thousands of dollars. By taking out student loans at relatively low interest rates, the individual can invest their available capital in other ventures, such as real estate, stocks, or business ventures, which may yield higher returns over time. The increased earning potential associated with careers in high-paying fields can often outweigh the cost of student loans. For instance, a medical specialist or corporate lawyer may earn significantly higher salaries compared to professionals in other fields. This higher income not only facilitates repayment of the student loans, but also enables the individual to build wealth and financial security over the long term. Moreover, student loans for high ROI education are often considered good debt because they finance investments in human capital that can lead to substantial career advancement and income growth. Unlike consumer debt used for discretionary spending, educational debt can potentially result in higher lifetime earnings and professional opportunities. It's important to note that the decision to take on student loans should be carefully considered based on individual financial circumstances, career goals, and expected return on investment. Factors such as interest rates, repayment terms, and the job market outlook for specific professions should all be evaluated before committing to educational debt. Additionally, effective financial planning and budgeting are essential to manage student loan repayment responsibly. Developing a repayment strategy and exploring options, such as income-driven repayment plans or loan forgiveness programs, can help alleviate financial stress and optimize the benefits of educational borrowing. In summary, using student loans to finance education in high-paying fields can be a strategic financial decision for wealthy individuals seeking to maximize their earning potential and long-term financial success. By leveraging educational debt to access lucrative career opportunities, these individuals can achieve significant returns on their investment in human capital, ultimately enhancing their overall wealth and professional fulfillment. Number 12. Construction loans. Construction loans are a specialized type of financing used to fund large-scale building projects. These loans are essential for developers and construction firms undertaking projects such as residential developments, commercial buildings, or infrastructure projects. Let's delve into how construction loans work and their significance in the real estate and construction industries. Developers and construction firms often require substantial capital to cover the costs of land acquisition, architectural plans, construction materials, labor, and other expenses associated with building projects. Traditional loans may not be suitable due to the unique financing needs and timelines of construction projects. Therefore, construction loans provide a tailored solution by offering funds that are dispersed in stages as the project progresses. These loans are typically short-term and have specific terms and conditions designed to manage the construction process effectively. Unlike conventional mortgages that provide a lump sum upfront, construction loans are dispersed in installments or draws based on predetermined milestones, such as completing foundation work, framing, plumbing, and so on. This phased disbursement ensures that funds are used efficiently and tied to the project's progress. Once the construction is complete, developers aim to sell or lease the finished properties to generate revenue. The profits from these sales or leases are then used to repay the construction loan. For example, a developer may secure a construction loan to build a new office complex. As each phase of construction is completed and units are sold or leased, the developer uses the proceeds to repay the loan amount, including interest. The ability to repay the construction loan hinges on the successful completion of the project and the market demand for the finished properties. Therefore, developers must carefully plan and manage every aspect of the construction process, from budgeting and scheduling to quality control and marketing. One significant advantage of construction loans is their flexibility and tailored approach to financing. Lenders may offer interest-only payments during the construction phase, which helps minimize financial strain on developers as they focus on completing the project. Once construction is finished and revenue starts flowing in from sales or leases, developers can transition to full repayment of the principal loan amount. However, construction loans also come with inherent risks. Delays in construction, cost overruns, or unexpected market shifts can impact the project's profitability and the developer's ability to repay the loan. Moreover, because construction loans are short-term and often involve higher interest rates compared to traditional mortgages, developers must factor in these costs when assessing the feasibility of their projects. In summary, construction loans play a crucial role in financing large building projects by providing developers and construction firms with the necessary capital to initiate and complete construction. These loans are structured to align with the project's timeline and milestones, with profits from property sales or leases used to repay the debt. While construction loans offer flexibility and support for development endeavors, they require careful planning, risk management, and market analysis to ensure successful project execution and financial viability. Number 13. Leveraging personal assets. Wealthy individuals often utilize their valuable assets, such as homes or stock portfolios, as collateral to secure loans for additional investments, thereby creating new income streams. This strategy, known as asset-based lending or leveraging, allows individuals to unlock the equity in their assets and access capital without liquidating their holdings. For example, consider a wealthy individual who owns a substantial amount of equity in their primary residence. Instead of selling the property to finance a new investment opportunity, they could use it as collateral to obtain a loan from a financial institution. This loan could be used to purchase income-generating assets such as rental properties, commercial real estate, or shares in promising businesses. Similarly, individuals with diversified investment portfolios can pledge their stocks, bonds, or mutual funds as collateral for a loan. This approach enables them to maintain their investment positions while leveraging the portfolio's value to fund additional investments. The borrowed funds can be deployed into various opportunities, including expanding a business, funding a startup, or acquiring shares in promising ventures. One of the key benefits of leveraging personal assets is the ability to amplify investment returns. By using borrowed funds to make additional investments, individuals can potentially increase their overall portfolio performance. For instance, if the return on the new investment exceeds the cost of borrowing, the individual can achieve a higher rate of return on their equity. Moreover, asset-based lending can provide individuals with liquidity to seize time-sensitive opportunities in the market. Whether it's capitalizing on a real estate deal, participating in a private equity investment, or funding a large-scale project, having access to borrowed funds secured by personal assets allows individuals to act swiftly and capitalize on favorable market conditions. However, leveraging personal assets also entails risks that individuals must carefully consider. If the value of the collateral assets declines, or if the investment does not generate the anticipated returns, there is a risk of financial loss and potential asset liquidation to repay the loan. Moreover, fluctuations in interest rates or adverse market conditions can impact the cost of borrowing and the feasibility of leveraging strategies. To mitigate these risks, individuals should conduct thorough due diligence on potential investments, maintain a diversified portfolio, and carefully manage their borrowing and repayment schedules. It's crucial to have a clear strategy for utilizing borrowed funds and a contingency plan in case of adverse outcomes. In summary, leveraging personal assets involves using valuable holdings, such as homes or investment portfolios, as collateral to secure loans for further investments. This strategy can unlock capital for income-generating opportunities, enhance investment returns, and provide liquidity for seizing market opportunities. While asset-based lending offers benefits in terms of flexibility and potential returns, it requires prudent financial management and risk mitigation strategies to safeguard against potential downsides. Number 14. Bonds and fixed income securities. Bonds are a fundamental financial instrument through which companies and governments raise capital from investors. This strategy allows entities to obtain funds without relinquishing ownership stakes, making it a pivotal component of corporate finance and investment portfolios. When a company issues bonds, it essentially borrows money from investors who purchase these bonds. In return, investors receive periodic interest payments, typically semi-annually or annually, throughout the bond's term. At maturity, the company repays the principal amount borrowed, thus completing the debt obligation. For investors, bonds offer several attractive features. First and foremost, bonds are considered relatively safer investments compared to stocks because they represent a contractual obligation by the issuing entity to repay the borrowed funds with interest. This characteristic makes bonds appealing to risk-averse investors seeking predictable income streams and capital preservation. Secondly, bonds provide diversification benefits within investment portfolios. They tend to exhibit lower volatility than equities, helping investors mitigate overall portfolio risk. By allocating funds to bonds, investors can achieve a balanced mix of assets that may enhance long-term returns while reducing overall portfolio volatility. From the issuer's perspective, issuing bonds can be advantageous for several reasons. Unlike equity financing, where ownership shares are sold to raise capital, bond issuance allows companies to maintain control and ownership. This is particularly beneficial for companies seeking to fund expansion projects, research and development initiatives, or operational expenses without diluting existing shareholders' equity. Furthermore, the interest payments on bonds are tax-deductible for the issuing company, providing a cost-effective source of financing compared to other forms of capital raising. This tax advantage can lower the overall cost of borrowing and improve the company's financial flexibility. Bonds come in various forms, including corporate bonds issued by private companies, government bonds issued by sovereign entities, municipal bonds issued by local governments, and international bonds issued in foreign currencies. Each type of bond carries different risk profiles, interest rates, and terms, allowing investors to choose bonds that align with their risk tolerance and investment objectives. In summary, bonds and fixed income securities play a crucial role in the global financial markets by enabling companies and governments to raise capital efficiently while providing investors with predictable income and portfolio diversification. The symbiotic relationship between issuers and investors through bonds illustrates a win-win scenario where companies access needed funds and investors earn reliable returns. This makes bonds a cornerstone of both corporate finance strategies and prudent investment management. Number 15. Debt consolidation for lower interest rates. Debt consolidation is a strategic financial maneuver where wealthy individuals combine multiple high-interest debts into a single lower-interest loan. This approach aims to streamline debt management, reduce overall interest expenses, and potentially improve cash flow for investment purposes. The process of debt consolidation typically involves taking out a new loan, such as a personal loan or a home equity loan, with favorable terms and interest rates. This new loan amount is used to pay off existing debts, including credit card balances, personal loans, and other high-interest obligations. By consolidating debts into one manageable payment, individuals can simplify their financial obligations and focus on repaying a single lender. One of the primary motivations for debt consolidation is to secure a lower interest rate than what is currently being paid on existing debts. High-interest debts, such as credit card balances, can accrue substantial interest charges over time, potentially hindering financial progress. By consolidating these debts into a lower interest loan, individuals can reduce the overall cost of borrowing and allocate more funds towards savings or investment opportunities. Moreover, debt consolidation can improve financial stability by providing a structured repayment plan with fixed monthly payments and a clear timeline for debt elimination. This predictability allows individuals to budget effectively and regain control over their financial situation, ultimately reducing stress and uncertainty associated with multiple debt obligations. In addition to lowering interest rates, debt consolidation may offer other financial benefits. For instance, individuals can improve their credit score by effectively managing and paying off consolidated debts on time. A higher credit score can lead to better terms on future loans, mortgages, and other financial products, further enhancing financial flexibility and opportunities for wealth accumulation. Furthermore, debt consolidation can free up cash flow that was previously allocated to high-interest debt payments. This additional liquidity can be redirected towards investments in income-generating assets, retirement savings, or other wealth-building endeavors. By leveraging freed-up cash flow for investments with higher potential returns, individuals can accelerate their path to financial independence and long-term prosperity. It's important to note that debt consolidation requires careful consideration and planning. Individuals should assess the total cost of the new loan, including any fees or charges associated with the consolidation process. They should also evaluate their ability to make consistent payments on the new loan to avoid falling back into debt or compromising their financial stability. In summary, debt consolidation for lower interest rates is a strategic financial strategy employed by wealthy individuals to streamline debt management, reduce interest expenses, and enhance cash flow for investment purposes. By consolidating high-interest debts into a single, more manageable loan, individuals can regain control over their finances, improve their financial position, and pursue long-term wealth-building opportunities. And there you have it, minus 15 ways rich people make money with debt. Remember, the key is to use debt wisely and strategically. If you found this video helpful, give it a thumbs up, and don't forget to subscribe to the Finance Hub for more insights into building wealth. Thanks for watching.